Good morning. Welcome to your daily morning digest for Sunday, February the 8th, 2026. I'm your host, and we have got a packed show for you today. Grab your coffee, get comfortable, because we're covering some massive market moves, a historic trade deal, and the ongoing AI revolution that's reshaping Wall Street as we speak. Let's dive right in. Let's start with the big headline. On Friday, Wall Street staged a powerful comeback rally. The Dow Jones Industrial Average soared 1,206 points, surging 2.5% and topping the 50,000 level for the very first time in history. Let that sink in. 50,000 on the Dow. The S&P 500 rallied 2% for its best single day since May, and the Nasdaq Composite leaped 2.2%. Now, what drove this? Chip stocks led the charge. Nvidia jumped 7.8%, trimming what had been a brutal 10% loss earlier in the week. Broadcom climbed 7.1%, completely erasing its weekly decline. These semiconductor giants benefited from renewed optimism about AI spending, and we'll get to that in a moment. But here's the reality check. Even with Friday's massive surge, the S&P 500 still posted its third losing week in the last four. The broader market remains under pressure from multiple directions: tariff concerns, AI disruption fears, and questions about whether big tech's enormous spending will actually deliver returns. The S&P 500 has essentially been trading sideways in 2026, sitting around 6830, and some analysts are warning that history suggests further declines could be ahead. So enjoy the rally, but keep your eyes wide open. Now let's talk crypto, because Bitcoin had an absolutely wild week. At its worst point late Thursday, Bitcoin briefly plunged near $60,000, effectively erasing all the gains it had made since Donald Trump's election in November 2024. Remember, Bitcoin hit an all-time high of around $126,000 per coin back in October 2025. So we're talking about a drop of more than 45% from the peak. But here's where it gets interesting. By Friday, Bitcoin staged a sharp recovery, bouncing back above $71,600. The broader crypto market followed suit, with Ethereum climbing back above $2,000 and XRP recovering above $1.45. What's driving this volatility? A combination of factors. The broader risk-off sentiment from tariff fears, concerns about regulatory uncertainty, and heavy liquidations that cascaded through the market. The sell-off was described as a sell-at-any-price rout by CoinDesk analysts. But there were also buyers stepping in. Binance, the world's largest crypto exchange, announced it added $233 million worth of Bitcoin to its SAFU user protection fund during the dip, converting from stablecoins to Bitcoin. Prediction markets are pricing $75,000 as the most likely Bitcoin price by end of February, suggesting the market expects relative stability from here. But after a week like this one, anything could happen. One of the most significant stories this week is the escalating AI spending war among big tech companies. Amazon CEO Andy Jassy announced late Thursday that the company expects to spend approximately $200 billion on investments this year. $200 billion. That's focused on what Jassy called seminal opportunities in AI, chips, robotics, and low Earth orbit satellites. This comes on the heels of Alphabet announcing similarly massive AI investment plans earlier in the week. Together, these companies are committing hundreds of billions of dollars to artificial intelligence infrastructure. Now, here's the tension. While this spending is great news for chipmakers like Nvidia and Broadcom, hence their Friday rally, it's creating serious anxiety about returns on investment. The big question Wall Street keeps asking is, will all these dollars actually generate enough profit to justify the investment? Amazon stock actually dropped 5.6% on Friday despite the broader rally, because investors are worried the spending is too aggressive. This is a classic tech cycle dynamic. Companies are terrified of being left behind in the AI race, so they're spending aggressively. But history shows that not every dollar spent on the next big thing generates returns. The market is trying to figure out who will be the winners and who will be pouring money into a hole. Speaking of AI disruption, this past week saw one of the most dramatic AI-driven market events yet. Anthropic, the company behind the Claude AI model, launched new plugins for its Claude Cowork agent that can automate tasks across legal services, sales, marketing, and data analysis. And Wall Street panicked. The initial announcement triggered a $285 billion rout in software, financial services, and asset management stocks in a single day. Companies like Pearson, Experian, and a host of European data services firms saw their shares fall sharply. By the end of the week, the sell-off had wiped out nearly $1 trillion from software and services stocks globally. This is a seismic moment. For years, AI was seen as a tailwind for software companies, a way to enhance their products and boost margins. But Anthropic's move flipped the narrative. Now AI is being seen as an existential threat to entire categories of software. If an AI agent can handle legal document review, data analysis, and marketing automation, what happens to the specialized software companies that built businesses around those functions? The market is repricing an entire sector in real time. Whether the sell-off is overdone or just the beginning remains to be seen, but this week proved that AI disruption isn't theoretical anymore. It's here, it's now, and it's moving fast. Shifting to geopolitics, a historic trade agreement was announced on Friday between the United States and India. The two countries issued a joint statement announcing a framework for an interim trade agreement that cuts U.S. tariffs on Indian goods from 25% down to 18%. This is a big deal. India gains duty-free access for key exports, including generic pharmaceuticals, gems, diamonds, and aircraft parts, industries where India is already globally competitive. The deal also opens what's being described as access to a $30 trillion market for Indian exporters. But there are conditions. Reports suggest the U.S. is pushing India to reduce its purchases of Russian oil as part of the broader agreement. India's Commerce Minister stated the deal will not include any item that would hurt Indian farmers, but opposition groups are already raising concerns. For markets, this is broadly positive. Reduced trade tensions between the world's largest and fifth largest economies signal a more stable global trading environment. It also suggests the Trump administration is willing to negotiate rather than simply impose blanket tariffs, which could ease some of the broader tariff anxiety that's been weighing on markets. Precious metals have been on an incredible run, and gold settled Friday at $4,979.80 per ounce. We are now knocking on the door of $5,000 gold. This is remarkable. Gold has been rallying aggressively as investors seek safe haven assets amid political turmoil, tariff uncertainty, and broader market volatility. Silver also edged up, adding 0.2% on Friday. However, prices did cool somewhat last week, after what were described as jaw-dropping rallies in recent weeks. The momentum paused briefly as some profit-taking kicked in. But the underlying drivers, geopolitical uncertainty, central bank buying, inflation concerns, remained firmly in place. For anyone watching commodities, $5,000 gold would be a psychologically significant milestone. Whether it breaks through and holds above that level will depend largely on how the tariff situation evolves, and whether global tensions escalate or ease in the coming weeks. On the tech consumer front, Samsung is gearing up for a major launch event. The Samsung Galaxy S26 Ultra is poised to make a significant splash in the smartphone market, with the company focusing on what it calls practical innovation and user-centric features. This comes at an interesting time, as Apple's iPhone 17 lineup is also generating buzz, with price comparisons being drawn across key markets. The premium smartphone segment remains fiercely competitive, and both Samsung and Apple are trying to differentiate through AI-powered features integrated directly into the device. Let me tie this all together with the bigger picture. We're at an interesting inflection point in early 2026. The market is being pulled in multiple directions simultaneously. On the positive side, AI spending continues to accelerate, the job market remains resilient, and trade tensions are showing signs of easing, with deals like the US-India framework. The Dow hitting 50,000 for the first time ever is a psychological milestone that shouldn't be underestimated. On the cautious side, Bitcoin's 45% decline from its peak signals that risk appetite is weakening. The trillion-dollar wipeout in software stocks shows how quickly AI disruption can reshape entire sectors. Tariff uncertainty continues to loom large, and gold near $5,000 tells you that smart money is hedging. Tom Lee of Fundstrat remains bullish long-term, recently reiterating his call for the S&P 500 to reach 15,000 by 2030. That implies 120% upside from current levels, but getting there won't be a straight line. Weeks like this one prove that. And now, let's shift gears to today's life wisdom segment. Today's wisdom comes from one of the greatest minds in business history, Charlie Munger, the late vice chairman of Berkshire Hathaway and Warren Buffett's legendary partner. Munger was known not just for his investing prowess, but for his mental models, frameworks for thinking clearly about complex problems. And perhaps his most powerful mental model was what he called inversion. Munger's advice was deceptively simple. Instead of asking how to succeed, ask how to fail. Then avoid doing those things. Instead of asking, how do I build a great life? Ask, what would guarantee a miserable life? Then don't do those things. This sounds almost too simple, right? But the power of inversion is profound. Munger borrowed this concept from the German mathematician Carl Jacobi, who was famous for solving difficult mathematical problems by inverting them. Invert, always invert, Jacobi would say. Here's why this works so well. When we try to figure out how to succeed, the path forward is often unclear. There are countless strategies, countless opinions, countless variables. Success is complex and often unpredictable. But failure? Failure is surprisingly predictable. Want to guarantee a miserable life? Munger had a list. Be unreliable. Don't learn from others' mistakes. Give up after the first setback. Let resentment consume you. Develop substance dependencies and avoid reading and learning. If you simply avoid these behaviors, you've eliminated most of the common paths to failure. Apply this to your career. Instead of asking, how do I get promoted? Try asking, what would guarantee I never get promoted? The answers are obvious. Miss deadlines, blame others for mistakes, refuse to learn new skills, gossip about colleagues, and coast on past accomplishments. Simply avoiding these behaviors puts you ahead of most people. Apply it to investing, a domain where Munger excelled. Instead of asking, how do I make money in the markets? Ask, how do I guarantee I lose money? The answers: trade on emotion, follow the herd, use excessive leverage, ignore fundamentals, and panic sell during downturns. Sound familiar? After this week's market action, that list should resonate. Apply it to relationships. Instead of asking, how do I build strong relationships? Ask, how do I destroy every relationship in my life? The answers: be selfish, break promises, never listen, take people for granted, and prioritize being right over being kind. Avoiding these behaviors doesn't guarantee great relationships, but it eliminates the most common destroyers. The beauty of inversion thinking is that it's practical. It cuts through the noise. We live in a world overflowing with advice about success. 10 steps to this, 7 habits for that. But Munger's insight was that avoiding stupidity is more reliable than seeking brilliance. You don't need to be the smartest person in the room. You just need to consistently avoid the dumbest decisions. As Munger put it, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. So here's my challenge to you today. Whatever goal you're working toward in your career, your health, your finances, your relationships, take 5 minutes and invert it. Ask yourself, what would guarantee failure? Write those things down. Then make sure you're not doing any of them. You might be surprised at how much clarity this simple exercise provides. Sometimes the path to success isn't about doing more. It's about stopping the things that hold you back. That's your morning digest for Sunday, February the 8th. Markets are moving, the world is shifting, and the future belongs to those who think clearly. Invert your problems, avoid the obvious mistakes, and keep showing up. Have a fantastic day ahead, and I'll see you right here tomorrow morning.